Despite the fact that we are in amidst an energy price shock, natural gas prices in Europe have fallen to multi-month lows, while in the US market we've seen a similar downtrend. And also, over the past couple of sessions, we've seen headlines focusing on natural gas prices falling into negative territory. We'll look at how that has occurred and also some of the technical factors to watch out for going forward. Welcome back to the channel. My name is Justin McQueen of Capital.com. But first, if you could like the video, that would really help out. And also, if you want to add to the debate, then please do send your comments in. Again, it could be whether you agree or disagree, see a different outlook, then please let us know. And of course, we're happy to discuss. And also, you can find out more information on the Capital.com website. Alongside this, please do subscribe if you want to be notified on the latest videos that we do put out on the Capital.com YouTube channel. Now back to natural gas prices. And again, as I mentioned before, with regards to negative gas prices, there have been some short-term reasons as to why that's occurred. Now, firstly, with regards to the US market, we've seen in the Permian Basin region, gas production set to surpass record levels by the end of November. So subsequently, oversupply in this market, which also comes at a time of where we're seeing pipeline constraints. Most notably, of course, the Freeport LNG terminal has been out of action since the summer months, and subsequently there is now less demand for US produced gas, and therefore creating that supply glut that we've been seeing over the past couple of weeks, and subsequently weighing down on the price of natural gas, in which we've seen the spot West Texas price falling into negative territory. But the reason as to why that's also happened this week is because we've seen scheduled maintenance closures of pipelines, and which has just really exacerbated that sort of lack of demand at a time where we're seeing a ramp up in gas production. So really those sort of supply demand imbalances weighing down on the price of West Texas spot natural gas prices, which have now moved to negative territory for the first time in over 2 years. And again, it's pretty uncommon, but it does still happen, and it can still happen going forward. And it's also something we've seen in Europe as well. Now, with regards to European natural gas prices, of course, we've seen them at multi-month lows, and just continuation of that downtrend. Now, some of the factors, of course, over in the Dutch natural gas price market, we've seen the next hour contract, which admittedly is not a massively traded contract, but did fall down into negative territory, much like we've seen in the US. And again, this is very much a short-term phenomenon. It's not really something that's going to sort of suggest that that's going to be the norm going forward. But really the case of why we're talking about that is because it can weigh down on the futures curve. And as we've seen in the past couple of sessions, that natural gas prices, particularly in Europe, have continued to pull back, with a couple of factors being the fact that EU storage capacity levels are now tracking at around about 94%, way ahead of their target of 80% by the beginning of November. And of course, the most exposed region, Germany, with regards to the Russia-Ukraine war and their reliance on gas coming out from Russia, they've filled up their storage capacity up to 98%. So therefore, we've seen this sort of reduced sort of concerns over buying as much gas as possible now that they're filling up the tanks. Alongside this, in terms of the seasonal factors, or the unseasonably milder weather that we're currently seeing in autumn. As I sit here in autumn, it doesn't feel like autumn, and that's much the case across Europe as well, where we're seeing reports that Germany and France could be seeing temperatures move above 20 degrees Celsius, which in turn means that they would be demanding less sort of heating oil, demand for heating, and therefore by extension there would be less demand for natural gas prices. Of course, this can change if we see a sort of a blizzard coming all the way from the east and spreading over into Europe. Then of course you'll see a pickup in demand on that. But at the moment, and why we're seeing gas prices continue to come under pressure, is also the fact that we're seeing much milder temperatures as we usually see during this time of the season, and hence why we continue to see a pullback in the gas prices across Europe and also on the US as well. Now, with regards to some of the key levels to watch out for currently on terms of the support side, and I'll show you in the charts in just a minute. Support $5.30 is a very big level. This has pretty much been the lows that we've seen back in July, and also the lows that we've seen this month as well. And they have been previous highs. So this is a very significant level. I think if we do see a break and a close below here, then we could be looking towards the next sort of support level, which is down at $5, which is only really just a sort of a psychological level that a lot of people would pay attention to. And also below there would be the 100 DMA at $4.93. So again, those are sort of your support areas to watch out for. Now, in terms of the top side, what we have here is the 55-week moving average at $6.22. And above there, if we manage to sort of see a bit more of a corrective move and break above, then that would lead us towards the $7 mark, which again is really just a sort of a psychological level that many people would be probably paying attention to. And just above there would be $7.29, which marks the 200 DMA. So again, those are your key technical levels that we'd be looking out for. And particularly, I'd be keeping closer eye on some of that key support at $5.30. So as we take a look in terms of the chart, and as you can see, we've continued to see declines over the past couple of weeks, having broken below this sort of consolidation period here. We've just sort of exacerbated on the downtrend over the past couple of sessions. And again, as I mentioned previously, that key support area is at 530. And as you can see, we bounced off here. Again, these are the July lows, October lows, and also the beginning of February sort of peak that we saw. So this is a key level support. We break and close below, then I suspect that we'd have more bearish pressure moving to the mid sort of 450 on natural gas prices. And keep in mind as well that the trend is still lower. We have bounced back off of oversold conditions, but we have failed to really move above the 50 area on the RSI. And subsequently, on the back of that, the path of least resistance is still to the downside, and something to keep an eye out for. I don't always pay close attention to it, but we're also seeing the faster moving average start to move below the slower moving average. And if we were to see either the 50 or the 55 DMA cross below the 200, then technically speaking, that would mark a death cross, which some people do pay attention to. I don't always, and I guess during those sort of periods, it's good to sort of backtest how reliable that is. But this is something anyway to keep your eyes out for if we were to see the 55, 50 to move below the 200 DMA. Now, in terms of the weekly chart, and as you can see here, this latest sort of uptick that we've seen off of oversold conditions have pretty much been capped at that 55 week moving average at near enough 622. And we're now testing the 6 handle on the downside. So again, really to sort of change this sort of outlook, we need to see a close above that area, such as to suggest that we could move towards the psychological 7 handle. I think at the moment the price is still pretty negative, particularly when you combine the fundamental factors with regards to the milder temperatures that we're seeing across Europe, alongside the oversupply in the US, and the fact that storage level capacity being filled across Europe is pretty much ahead of schedule. Of course, this can turn if we were to see an escalation of the violence between Russia and Ukraine. Then, of course, that would kickstart the move higher in natural gas prices. But at the moment, we have been a little bit quiet on that front. And so therefore, we've just been playing to these sort of short-term supply-demand imbalances, which have been weighing down on the market. So in terms of a recap of some of the main factors at play, as I mentioned, the oversupply conditions in the US with regards to the Permian Basin region set to hit record levels of production at a time we are seeing pipeline constraints, therefore a lack of demand to be able to shift this record amount of natural gas production, which in turn, of course, has exerted downward pressure in the very short term with some contracts hitting negative prices, but also across Europe. The milder temperature alongside storage capacity way ahead of schedule with Europe at 94% of capacities filled, ahead of the 80% which had been targeted for the beginning of November. Now, the question, of course, is whether this is the end of the energy price crisis. I don't think so. And again, it would only just take an escalation of the Russia-Ukraine war to see renewed upside in the natural gas market. That's it from me. Thank you for listening. And again, if you like the video, then please give it a thumbs up. And also, if you want to add to the debate, then send your comments in. And if you want to be notified with regards to our latest videos that we put out on the Capital.com YouTube channel, then please do subscribe to the channel. That's it from me, and good luck trading out there.